Ladies and gentlemen, with Halloween fast approaching, we are seeing one of the weirdest market cycles I've ever experienced in my entire life. We're going to take a look at both sides of the border, the Canadian markets, the US markets. I mean, in the US markets, we recently just saw earnings come out of Microsoft and Google. We're going to analyze them briefly, but they are crashing miserably today, yet the indices are still able to rally, and unusually enough, small caps are absolutely exploding. Risk on is coming back this month. I mean, take a look at crypto right now. It's just blowing up. We're also going to take a look at the Canadian interest rate environment as the Bank of Canada just raised the rate again. So we'll dive down into my own personal Scotiabank, my bank account, to see what the interest rate, the savings account rates look like, GICs, bonds, things like that. So that's a conversation you can appreciate. Hit that like button, folks, because let's start with the Canadian side of the border with first and foremost today, guys, they raised the overnight interest rate by 50 basis points, taking it to 3 3/4 total. But a really interesting quote came out of this. Basically, the economy continues to operate in excess demand and labor markets remain tight. This is so weird, as the demand for goods and services is still running ahead of the economy's ability to supply them, putting upward pressure on domestic inflation, yet businesses continue to report widespread labor shortages, and with the full reopening of the economy, their strong demand has led to a sharp rise in the price of services. So the services, the entertainment industry, restaurants, they're really competing to basically get, employees back in those shops. While inflation, guys, apparently there's still a lot of demand for products. This is like, again, it's just such a weird recession where the jobs market's doing so well and there's still competition for products and things like that. But what I'm telling you right now is inflation is damn dead. In the US and Canada, the inflation rate shouldn't be a story. I think the Fed and the Canadian Bank are just spreading FUD because they want to keep the market suppressed while they get a lot of things under control here. But when you look at the August to September inflation data from the Bank of Canada here, it only went up 0.1%, guys. And in the US, if you look at it from July and you calculated it from July, we're back to that nominal 2 to 3%. But because they take the total inflation rate over a trailing 12-month period, that's where you're going to see the 6.9% in the US, over 7%, these really high inflation numbers, which won't start rolling off on the 12-month till January, February, and really start rolling off in May. So I'm done with inflation. I think it's over. I don't think we're going to see any insanity anymore from that standpoint. But take a look at this, because the TSX, guys, is rallying really aggressively here from the lows, up 6.55%. The Vanguard S&P 500 index, guys, from the recent lows is up 10%. I don't know if this is a bear market rally. I know the FUD spreaders like Michael Burry would like to think so, but like I said, cost averaging and really investing money heavily over the last 2 weeks, when we do my portfolio review on Friday, is really going to show some really decent gains. So consider subscribing for that in-depth review if you guys like the clarity into the transparency of my portfolio. Is my favorite index funds, guys. Take a look at this. From the bottoms this month for VDY, the Canadian High Dividend Yield ETF, is up 4.2%, and on the year now is only down 4%, and paying a 4% dividend is basically flat from a return basis for this entire year. But putting that aside, take a look at my bank accounts, guys. The premium rate from Scotia, which isn't the best, right now on the 360 is 2.6%. Not the best, but still, these are much better, higher interest savings accounts than we've seen historically since I've been basically with Bank of Nova Scotia. But even from a GIC standpoint, if you're in retirement, I would be locking these in, man. And I would probably go for some of these 4 and 5 year rates at this point, because we're going to start seeing the tampering of these high interest raising environments. I mean, what was it the last Bank of Canada meeting, they raised it by 0.75 basis points. But take a look at this, because my God, guys, you can almost get 5% now on GICs, which is just unheard of. So putting that aside, take a look at earnings. I mean, Google is tanking miserably. It's now down 32% year to date since the recent earnings came out, guys. Dropped pretty aggressively here by as much as 7 or 8%. And just taking a look at those Google earnings, why did that happen? Well, there's a lot of fear in the slowdown of the market, even though the company is still growing revenues, which is pretty incredible. Year over year, the revenue, guys, grew by 6% from 65 billion to 69 billion here in 2022. But a lot of people were annoyed because YouTube ads saw a decline from 7.2 billion to 7 billion. Not the best, but Google search and others still up for the year, and their cloud computing, which I think is what's going to boast everything from Microsoft to Amazon. Cloud computing is where all the money's at. As we can currently see, it went from 4.9 billion to 6.8 billion. But all in all, I would not call this a bad earnings cycle and a continued sign of a discount in that stock, because when the market starts to recover, probably into 2024, and we start seeing growth rates start to come back, that's when these stocks are going to start rallying super aggressively. I can promise promise you that, because all right now the sell-off is rated to the projected future cash flow, which a lot of people think is dead. They think it's dying off. They think it's going to go to 6%, and they think that that growth rate on Google is going to stay at 5 or 6. I'm arguing it's going to come back to probably well over 10% in the future. But Microsoft, guys, another one here. On the last day, we also saw a wicked sell-off by a very similar amount to Google. And just taking a look, guys, their revenue is very similar. Year over year, guys, from 45 billion to 50 billion is a pretty wicked increase, a healthy increase in my opinion, but a lot of people, again, pointing fingers at specific segments like the slowing in obviously Microsoft products. I mean, Xbox continues to see a very big slowdown to about 3% from the gap year over year. But nonetheless, guys, just taking a look at the cloud revenue is up pretty dramatically. Azure, AWS is with Amazon, but Azure cloud service is up 35%. So they still have these wicked fast growing segments, and it's very similar. And I think this is going to be a sign across the entire tech spectrum for earnings this week. I'm very excited for Apple. I think Apple is going to be the true defining factor of what happens with the broader market, because Apple has just been holding up very well. And there's a lot of speculation about those iPhone sales, which we're going to get into on Apple's earnings on Thursday. But take a look at this, because we're seeing Google down, everything down in the tech industry, yet VOO, being top tech weighted heavy, is still up 0.57%. Bitcoin is rallying 5% today, ETH up over 12%. But as we scroll down here, guys, where things get really interesting is in the speculative market. Are we starting to see a speculative rally? Is this the bottom of the spec crash? I don't really know. I'd love to know what you think about it, because take a look at this. The ARK Innovation ETF up 4% today. ARK G up over 5%. Coins up about 4%. The real small caps like Ouster, Momentus, some of these stocks used to follow like Hyliion are up pretty dramatically today. Rocket Labs up almost 7%. Even the MJ market, look at Canopy's up 11% alone today. So this is just so weird and just so unusual of a market to try and wrap your head around. And I'd love to know what you think about it in that comment section below. So stay cool, stay awesome. And as always, I look forward to catching you in the next one.